So every single Wednesday, we do something that we call Chart Day in our private community. These are live sessions that are about an hour, hour and a half long. They're raw, unedited, unscripted. Today, I want to share one with the YouTube community. Enjoy. It's Wednesday, March 11th. And you know what time it is? Every single Wednesday in our private community, we do what's called Chart Day. We've been doing this for 5-6 years. We look at the S&P 500, the QQQ, and 20 individual stock tickers chosen by you, the community member. And we're going to go through some real talk. We're going to look at some financials too, because remember that only 1% of investing is actually technical analysis. 99% is the fundamentals. That's the qualitative and quantitative analysis that we teach in the masterclass videos. So hope you guys are doing well. I'm going to get you up to speed with the markets today and go through some tickers. So let me know if you can hear me and sound and video is good, and we'll get started here on this stream. First thing I want to talk about today, we have consumer prices rose 2.4% annually. That is as expected, but remember that CPI is a lagging indicator. So as oil prices go higher, we just had $115, $110 a barrel, dip back below $100 a barrel. That's a big deal when we're just in the 50s and 60s, because that's going to raise the prices at the pump. It's going to raise prices for shipping. It's going to increase inflation. And it's very possible, if we don't have a resolution quickly, that you could see, as we start to get lagging indicators, and in the coming months, you could see this inflation rise. The problem with inflation rising or staying hot, because we want to get it to that Fed rate of 2%. Well, the Fed, which is also going through some situation here, Jerome Powell, we're going to be replacing with the Fed chair, right? So we've got that kind of going on. People are a little bit nervous about that. But then the Fed's in a position where they can't really cut. They might have to hold rates steady, or even worse, they might have to raise rates if inflation starts going the wrong direction. So thanks for letting me know, sound and video good. That is what's going on here with this morning. I mean, it's good news, but it's also lagging. So it's not really that helpful, because it's talking about, February, and we're at March 11th, and most of the oil prices have been just in the last few days. So we need to now get the next report in March and see what that looks like, right? Looking at Oracle, we had earnings last night, 10% higher in pre-market. We'll see how that holds up. We did have a pretty nice beat and overall raise. Looking at this, the software firm said the cloud revenue jumped 44%. I need to fix something here. 44% to $8.9 billion in the third quarter. What's more, Oracle's remaining performance obligations, so that RPO, this is somewhat controversial, right? But quadrupled from a year ago to over $550 billion. So that means if all of this came to fruition, that's a big number. More than likely, not all of it does. RPOs is one of those things that there's no guarantee there, right? It's remaining performance obligations, and show me the money. Show me what you've done for me lately, kind of a thing. But it is a positive overall, especially when cloud revenue is growing 44%. And you have a company that's not a young company by any means. It's been around quite a while, growing at 22% year over year, pays a dividend, beat by 10 cents here. So not bad at all for Oracle. Looking at the broader markets here, you can see futures are down. We've had a lot of volatility. Last couple trading days goes from red to green, red to green. Oil is at 87, which is still elevated. It's definitely better than 100 plus, but it's still elevated. You have the VIX has been spiking, got over 35 for the first time since April 2025. So keep an eye on the VIX. If you look at the fear and greed index, I'll show you that in a second. But gold is at 5184, crypto, Bitcoin still under 70,000 at 69,380. But looking at that fear and greed, this is something that was actually in extreme fear for just a little bit. I think it's back to, it's actually in extreme fear. So yesterday when I looked, it was back into 27 range in fear, but we're hovering around that 25. And of course, this goes from 0 to 100. So the worst you can get is 0, in terms of fear. And then extreme greed would be 100. We did see something like, I think, a 2 in April of 2025, something like that. So, there's quite a bit of room to go down there. And that's a good segue into what we're going to cover next, which is the S&P 500. Now, when you see yellow, that's today's chart day. Orange, previous chart days. We do these every Wednesday, so they get pretty busy. I try to keep them as neat as I can. We've been telling you, if you look at this, is the most recent. So last week, bullish bias above 67.80. but I wouldn't be shocked to see 66.30 to 67.17, especially if, more tensions heat up in the Middle East and there's no resolution soon. And that's what we have seen. In fact, the market's been very resilient, holding up better than I would expect considering what's going on. So right now, the S&P 500, I don't think 6,500 to 6,650 is out of the question. It doesn't have to happen, but I think it is a possibility that you see 6,500 to 6,650. That's the expectation, really below 7,000. So my expectation is you're going to get 6,500. It could even go lower than that, but it doesn't have to go to 6,500. We did see that 6,650 area once and it bounced off of that. So it got down here just above the 200-day moving average. That's that purple line. And it got right in that 6,650 range and then bounced up. So right now we're sitting at 67.80, and it gives you a little buffer, about 280 points from that 6,500, what I think is a potential floor if we get selling to the downside. And the 200-day simple moving average here, that purple line, is about 6,600. So that's kind of where we're at. Of course, you can see, we ripped from this 2022 bear market from 34.91. We ripped up to 61.47. Then we had the April 2025 sell-off. It sold off all the way down to 48.35, which takes you back to the highs of 2021, the peak of the pandemic rally. It went down there, retested, bounced off that V-shaped recovery, and it's been off to the races, got to 7,000 and really rolled over at just over 7,000, 7,002. So that's where we're at. It really leans somewhat bearish, but here's what's contradictory to that. The QQQ, this is NASDAQ 100. This is counterintuitive because 640 to 650 is what I see as a potential bounce to the upside. So this is more of a bullish chart, which is kind of telling you that tech, it was out of fashion. You were seeing a lot of rotation, right? From those tech stocks, software stocks, into those blue chip stocks, the Walmarts and John Deere's of the world, things like that, the safer type stocks that especially consumer staples and things like that. When there's uncertainty, people like to park their money in places that are a little bit safer, risk off. You saw crypto sell off. You see growth assets, growth stocks sell off, especially speculative type investments, high flyers. We told you that was going to happen coming into this year, that the market was going to be more selective, and that you would probably see a reckoning in some of those higher priced names, the high flyers, high price of sales, no profitability. And we have seen some of that. Now you're seeing a little bit, maybe that rotation back here recently. I think the market wants to go higher. I think the market wants to come back into tech and come back into software. But at the same time, we've got these Middle East tensions, which every day it goes on, the worse it can get, because it is going to drag inflation higher. We also have unemployment, which last time we talked, unemployment is going the wrong direction. It's going higher. AI is still threatening jobs. You're seeing layoffs. So there are some cracks in the foundation underneath the surface if you look closely. And even though I want to be, that perma bull that says, yay, keep investing, you're going to get rich. And that is true, right? Because long term, I do believe that if you buy a high quality business today, even if it's expensive, in 5 or 10 years, you're going to be happy with that. But the problem is that you also have to be aware and not just naive to the fact that the market could have some pressure. It could sell off, and you want to have cash for that. And that's really what it's all about, is making sure you're positioned well to benefit if the market goes the other way, especially your favorite stocks that fit in your blueprint. So I've seen recently some comments about, hey, I don't have any more cash. That's just a discipline thing where you got to work on that. Because you should have 5% cash as part of your portfolio, and you should be replenishing that every paycheck. It's going to dwindle down when you get really heavy sell-offs, like you have something like April 2025 or even 2022 in the bear market. Pretty much, we were all kind of out of cash, and as soon as we got some money, we'd put it in the market because we knew the prices were good. Even if they went lower, we knew the prices were good. That's not really the situation we're in now. There are some opportunities in software, but they're still not, like CrowdStrike is a good company at $350, but it's still not dirt cheap. In fact, you could argue it's expensive there, right? So you should have some cash still. You should have 5% cash. And if you're more conservative, you probably need to have more like 10% cash. So think about that. You might have to raise some cash. Now there's a chance that the market just pops tomorrow and you say, well, good thing I didn't have any cash. Don't look at it that way. Look at it as you want to always be in a position to win. You want your cake and eat it too. What do I mean by that? If I'm 90% long in stocks or 95% in stocks and the market rips, I'm going to benefit. I'm not going to be like, oh, I wish that other 5% in my portfolio that's cash, I wish that would have been in Nvidia because it would be worth more. I don't think you're going to do that. So you won't even think about it. Where you will think about it is the market crashes 10% tomorrow and you have zero cash. That's going to gut you. That's going to feel horrible. You know, one of the top 15 investing rules, always have some cash. There's nothing worse than your favorite stocks on sale in a fire sale and you've got no money to buy them. So think about that. It's part of peace of mind too. You want your cake and eat it too. You want to be long, but I still want to have 5 and 10% cash because I don't know what's going to happen. And if I do get an opportunity like an April 2025 event, I want to take advantage of that. And I don't want you to feel the pain of not being prepared. So you'll have to look at your portfolio and figure that out. If you're light on cash, figure it out. And if you can't, well, it's a learning lesson. If it happens, I told you so. Now learn for the next time, because hopefully you have lots of years in front of you and you're going to see another sell-off again, right? We're going to always have sell-off. It's just a matter of when. There's always a bear market coming. It's just a matter of when. So right now, this does lean bullish, the QQQ, NASDAQ 100. A little bit counterintuitive, the S&P 500 chart. So really what it's telling you is the market's just kind of in a 50-50 ball, and it's going to depend on what happens if a resolution happens quickly. You know, if you listen to the president, he's talking about we're ahead of schedule. It's going to happen quickly. If that happens, the market could rally. It probably ends up fading later anyway, a little bit. But where you could really get in trouble is if that inflation starts to deteriorate some of the fundamentals, the macro data, right? So risks are stacking up. It should say stacking up daily. Stacking up daily. They're going higher, stacking up higher every day. And it's foolish not to expect lower later, lower prices at some point later. It could be this afternoon or next week, but it doesn't have to happen. And I want you to hear that again. It does not have to happen. And you don't have to guess right. You have to be in a position to win at all times. That is your job as a money manager. And that's what you are if you're managing your own money. Visa is the first stock. Dominic, how you doing? So Visa, fintech is kryptonite. This is one of the higher quality names probably, but there was a time in my life when all these were trash because crypto is going to replace it next week. Well, here we are years later, and the stock is up quite a bit higher from whenever that story, started going across the internet. So the air pocket popped. You get up to 373. This is a pretty aggressive air pocket. This is a pretty parabolic run from a 169 November 2022 and pretty much straight up over a couple year period to 373. Finally, air pocket popped. It's still elevated at $300, but much better than 375. It is below the trend line, which is a very parabolic, very vertical type trend line, past 45 degrees. It leans bullish right now. Visa does the 340 to 350. It's at about 314 pre-market, 313. But that's if the market holds up. If the market doesn't hold up, inflation starts going the other way, the Fed decides to raise rates. Well, all of these charts we talk about today, they're going to go lower. Understand that. People will say, yeah, I'm watching your video and you say, hey, I like this stock at this price. It could go higher and it could go lower. That's true. If anybody tells you otherwise, they're full of what. They're full of horse manure because nobody knows what's going to happen. If anybody pretends to know, because especially as investors, what we can do is we can invest high quality businesses that we believe will be worth more later based on trends, based on the financials, based on the leadership. But there's never a guarantee with anything, and especially a short-term move. You can't predict what's going to happen in the Middle East today or tomorrow, and that will impact your portfolio. But if you believe in the future of the business, the future of the United States economy, well, you don't have to be right and have to guess. Where you create problems for yourself was when you become a trader and you have to be right because you're gambling on being right or wrong. You could have said, hey, I know NVIDIA is going to crush earnings. It's going to beat on top bottom lines. It's going to blow out any of the guidance numbers. It's just going to crush across the board. And because of that, I'm going to do a naked YOLO call and I'm going to get rich. But what happened? NVIDIA did crush it and the stock went from 200 to 175. And you lost your ass if you were doing anything risky, leveraged on margin and so on. And this is why traders lose over and over again. NVIDIA will go higher with time. Once that digestion happens, I still believe you'll see 250 this year. But guessing if it's going to be this week, next week, or next month, that's a lot harder than saying, hey, I think it's going to be a $250 stock sometime this year. And the thing about long-term investing is if it's not this year and it's next February, that's okay. I've got time. That's the whole point of long-term investing. You're not trying to get rich quick. You've got a 10-year horizon, a 15-year horizon, whatever that horizon is before you want to be financially free. And you're buying high quality businesses and eliminating the stress and the drama of the gambling and trying to have to guess what's right and literally trying to bet against the suits in the street. Good luck. Wall Street's, got an army of people and quants and algorithms and everything else. You think you're going to go against that and win? No. Long-term investing is where it's at. So if Visa has a future and you believe in the company, well, $300, this is where you buy because it was $370. It's pulled back. Now, of course, you're going to look not just at the chart. We're going to look at the fundamentals, which again are 99%. And that's both quantitative, which we're going to look at now, and qualitative. Qualitative is the story of it. The leadership, the gut feel, looking at what the projected total addressable market might be, what the future of fintech might be. That's going to be subjective. You can't measure that. This is why accountants sometimes struggle at investing. They want black and white and check marks, check boxes, and it doesn't work. If you're a growth investor, you have to have a blend, that 99%, a blend of quantitative and qualitative analysis. I would argue in something like Visa, it's going to be a lot more on the quantitative side. But if you're talking about, something like Rocket Lab, you flip-flop it a little bit, right? So profitability, on something like Visa is 97%. It's showing you really strong $600,000 net income per employee, revenue growth 11%, valuation, not dirt cheap, but not bad, 25, and it's going to pay you a small dividend, pays you 0.85%. So it's a DGIF type of a stock, right? How's this thing done over the last 5 years? It's down 8% in the past year. It's actually lagged the S&P 500 over the past 5 years. Of course, you zoom the lens out, it's done really well, 326% in the last 10 years. But not surprising in the last 5 years because of the fact the sentiment's been really poor on fintech in general and credit cards. But really, if you look at it, they're still just crushing it. A lot of people have been afraid of it because of crypto and other reasons. But if you look at this chart, it's really done nothing. If you look at a 5-year chart on this, it basically didn't do anything from 2021 to 2023 here, and then a little bump up. And it's really flatlined again for, going on another year since February of 25. So, the question's always, does it fit your blueprint and why? Do you want fintech part of it? And if it is, great, but that's something you have to answer. You don't just buy it because of the chart or because you looked at a quick thing on Seeking Alpha. The main thing, we've talked about this many times, you have to have a plan and you have to build a blueprint. Just last time we did Chart Day last Wednesday, go watch that if you haven't. We talked about the blueprint and how you build that blueprint out. And it's really important to understand because I'm going to often say, what does your blueprint say? Hey, should I buy Visa? Well, what does your blueprint say? Do you have fintech in your blueprint? If not, then why are we talking about Visa? And it makes things a lot simpler. So make sure you have a blueprint. This is ABBNY. This is over-the-counter OTC, so be mindful. Often these charts aren't very useful. It is in an air pocket here. You can see quite a bit above the trend. Kind of came down to the 50-day simple moving average, this yellow line, bounced off that. This R3 is up here at $99. You got an S3 at 81, so you really have a fib range of 81 to 90 to 900 bucks. If I look at one of these risk rewards, you never buy off of this. But let's just say the previous S3 is your downside. Let's say the R3 is your upside, the Fibonacci R3. Let's just, and you can move this however you want. But right now, the stock price is right here. So here's your upside. Here's your downside. That's not great risk reward. Now, of course, 5 years from now, it could be much higher than this. And so you say, hey, I thought you're a long-term investor. Why are you looking at short-term? Because charts really are going to give you only a glimpse of what can happen short-term, and really it's looking at historical data. Well, it's 1%. This is 1% of the equation. So if the fundamentals say, hey, this is a screaming buy, then this 1% is not going to be that much weight. And then this risk reward chart here, this red and green chart, that's one tool in a tool belt out of that 1%. So this is a fraction of a percent here, but it's a good visual, right? Either way, though, if this is a fringe play, we're going to talk about this later, guys. The message of the day today, what I really want you guys to learn, especially newer members, the two different types of dollar cost averaging, what they are exactly, and how do you use them. We will talk about that later in the video. So make sure you watch this video because this could be life-changing stuff A lot of people, even people that have been in our community for a little while, don't totally grasp this. So I'm going to tackle it today. There will be more masterclass videos in 26, and I'll try to tackle it in more detail there as well. But I do want to make sure you understand this moving forward the best you can. That's where we're at with this one. The next stock is Texas Roadhouse, TXRH. Anybody ever eat here? Pretty good place. It's not the best steak in the world, but for what you get, the value of it. It's a fun family outing and pretty decent quality overall. Not bad at all. It's not dirt cheap, but nothing is anymore, right? But the Texas Roadhouse, the fib range on this is 163. So that's here. The previous S3 is 149, but you have this 163 here and then 201 R3. So this is your fib range. Same kind of deal. If you drew this up, here's the upside, the green. And I would use the previous S3 as maybe the downside, but you could do this if you wanted to. And, it's looking pretty good. This risk reward's a lot better. Now, of course, you can adjust this down and say, well, it's still, you want to have more green than red. And in this case, you do. Not a reason to go buy the stock by any means, of course, right? But this isn't crazy expensive. I want to look at Seeking Alpha. It's not cheap, but it's not crazy expensive. So for a restaurant, it's probably close to fair value. I would like a little bit better price. We actually bought this stock under $100 in the community portfolio. So we got a pretty good buy on that. I think mostly thanks to Matt Payne. Gross profit margin is only 16%. That's always going to be a problem with restaurants for the most part. Now, you see some restaurants like Kava a little higher. Sometimes you get 30% and stuff, but 15%. If I look at McDonald's, what's scary about that is they're running a 57% gross profit margin. They've got it down to a T. And that's also showing you that the quality of the food's probably not that great, but they also, whatever they get is dirt cheap on top of it. That's crazy margins, 57% on fast food. You look at something like Kava. Kava is going to be in that 37%, which is still really strong. Growth on something like Kava is 22%. McDonald's is going to have much slower growth. It's been around a long time, 5%. And I look at Texas Roadhouse. Texas Roadhouse growth, we're sitting around 10%. So maybe double McDonald's, but not even close to Kava. Profitability also not even close to either of those. Valuation 27 gap 4P ratio. And of course, these are all different restaurants, right? I'm not saying McDonald's and Texas Roadhouse are the same. I'm just showing you the restaurant industry. This is a 25, right? You look at like a Kava, you got three kind of different types of restaurants. Well, this is growing at 22%, we said earlier here. But it's also trading at 158 gap 4P ratio. McDonald's has hardly any growth and it's sitting at a 25. Of course, it's going to have a higher dividend because it does pay a dividend here, 2.27%. So this is more of a dividend type paying stock. Kava, of course, doesn't. And then you got Texas Roadhouse. Texas Roadhouse does pay a 1.74% dividend. This would probably fall in the DGIF type category. The valuation on this, though, 27 gap 4P ratio. So again, probably about where it should be, maybe 20 to 25 in this kind of market is what I would expect for something like Texas Roadhouse. In the last year, it's actually down 3.5%. In the past 5 years, it's up 80%. So it's done pretty well. If I look at the VU over the past 5 years, this is up about 71%. So Texas Roadhouse in the last 5 years has outperformed the S&P 500. Does it have to, do it again? No. Past performance is never a guarantee of future results. This is $11 billion market cap, 4% short interest. And, this is probably fits more in that DGIF type category. One of the few DGIFs, because it does have 14 years dividend growth. It's got this 5-year growth rate that is really strong at 49%. Payout ratio is still low enough. You want under 50%. So this would be a DGIF play, a nice one, I think. You have to understand restaurants, though, are going to be very cyclical, and this might be cool for 5 more years, 10 more years until it's not. It's very much a fad. Chi-Chi's was really cool once. Red Lobster was really cool once, and so on. So is Texas Roadhouse still going to be as relevant in 10 years? Probably not. I mean, there are some restaurants that have stood the test of time better than others. Like Olive Garden is still around. I would say it's not nearly as popular as it was, but it's still doing okay. Part of Darden Restaurants, I believe. Restaurants are tough. I'm part of one of a restaurant. I've been in the restaurant industry for years. I really cut my teeth in restaurants. My first job out of college, managed a barbecue shack, right? They're tough. These are tough investments. I do like Texas Roadhouse. We own a small position in the community portfolio, and it is a strong, if you're trying to diversify into restaurants, you want a DJIF, this is one of very few options you have. Casey's, another really strong DJIF, pays a pretty tiny dividend. Now, this is from Ever. Ever, I believe you're in Iowa. So my guess is that you see one of these Casey's like on every corner. And that's why you're thinking, hey, is this a buy? Same as last. We said crazy chart will go higher till it doesn't. Well, same deal. It's going to go higher till it doesn't. This R3 is 744. And they're growing like crazy in terms of store count. Every single time you go somewhere, you see another Casey's popping up on a corner somewhere in the Midwest. But it never seems to align with the revenue growth. And I'll show you what I mean. Because I see stores like every day, it seems like popping up. This does pay a small dividend, 0.33%. So it is a DJIF, but it's a very small dividend. That's not necessarily bad, though. So those can be some of the greatest compounders. Profitability, 25%. It's a convenience store, gas station, convenience store. It's bringing in about $17,000, $18,000 net income per employee. It's about what you expect. The growth, though, is pretty solid overall. You got a B on Seeking Alpha, but that forward revenue growth about 7%. And it feels like they're growing at more than 7%, right? So just understand the disconnect there. And then the price is 38.73. And I own the stock and sold it because I needed the cash in April 2025, but also because it's kind of expensive for what you're getting. You're paying almost a 40 PE ratio for 6% growth. And it's just one of those stocks that holds a higher valuation until it doesn't. NVIDIA's, a 22 gap forward P ratio, damn near half the price of Casey's, and it's growing at 53%. Of course, very different things. And people are, going to flood to a Casey's type stock because it's one that AI can't disrupt. You're still going to need probably gas. I mean, it can a little bit. If not as many people are working, they don't need as much gas and so on. But for the most part, convenience stores are probably going to be around. AI is not going to just like completely disrupt that and change it. But yeah, it's Casey's a good company. It's not cheap for what you get. It reminds me of Texas Roadhouse. It carried a premium for a long time until it didn't. And now it's kind of, not really in fashion. And if I look at that one, Tractor Supply Company, I've been buying some recently here under $50. It's up pre-market to 51. But the same kind of deal, 36% profitability. Growth is only like 5%. Growth was doing really good. It slowed down. So if I look at the last year, that stock's down 12%. Over the past 5 years, it's only up 50%. So it's underperformed the S&P 500. If you look at, over a certain period, like 10 years is 181% too. But if I look at a certain period, there was a certain period over a 3-year period where it did really well, right? So this is one that you own because really like it's a dividend type stock. It's a DJIF because it has the dividend growth, the 5-year growth rate, payout ratio is decent. But when you look at the true definition of DJIF and you start looking at like 5-year performance, you're right in line because you're looking at 10%, right? You're looking at 10% a year. Now the S&P outperformed that, but you're not necessarily looking and saying it has to be the S&P. You're saying I want 10% growth on the dividend and the stock over that period, and it does that. But this is not growing as well. The financials have deteriorated a little bit since a few years ago. I still like the company, right? But you have to understand this is going to have a different valuation. It's going to trade at 25 versus a 30, 38 or whatever, like Casey's, because of the situation it's in and the growth and things like that. So anyway, long-winded story on Casey's. I like the stock, but there's a little bit of disconnect on the value. Understand that. And, be careful, I think, of that as well. This is AS. Is it Amer Sports? Is that how you say that? It's interesting because I haven't really heard of it. It's growing like crazy, though, like 36% growth. R3 is $46 up here on the upside. You're sitting right now at about $34.69. Market's going to open here any second. This previous S3 is down here closer to $30. But it ripped from $10. This is $10 in July of 2024, all the way to 42. You got a double top at 42. So at 42 to 29, back to 42. Wouldn't be surprised if it came down and did a double bottom at 29, but it doesn't have to, right? It doesn't have to. It's kind of holding this trend. You can see the parabolic trend, but you've got dot, 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 and it kind of broke past that, went above it. So it's kind of holding the algorithmic trend. It's an interesting one. I looked at this last night. just briefly. And if you look at the value, the growth on this thing, I'm gonna take a drink while this loads. Valuation, it's not like cheap or anything, but 34 P ratio. The growth is a 20%. I was thinking it was 30, but 20, still pretty good. Profitability 57%, pretty solid there overall. I don't know much about this company at all. It has 2% short interest, a $20 billion market cap, which seems like a big market cap for a company that I don't know very well. So global leader. Okay, so Wilson. So I have heard of this, Solomon Wilson Atomic. I just never heard of the parent company, I guess. But very, very interesting. Company is formerly known as Amer Sports Management Holdings, Cayman Islands, before changing its name in 2023 and went public on the New York Stock Exchange. So if this is headquartered in Cayman Islands, just be careful with that as well. But there you go. I mean, where's it going? Well, it could go up to the R3, $46, but you're paying quite the premium as a $10 stock, so you are chasing. Roblox. Speaking of chasing, here's what happens when you chase. You get your head torn off. FOMO Chasers Pizza, right? I told you here, I said, hey, this is parabolic, but it can run higher short term. Do not chase. I said R3 118. Well, it went past 118 all the way to 150. And you're like, that's stupid, Eric. It was 110. He told me not to buy it. It went to 150. Well, if you're trading and you're really quick, because this happened very fast, look at how short that candle is. That's like a one-day retracement. I said buying charts like this is bad for your long-term health. If you're a long-term investor and you're buying this and trying to hold it and you're buying this momentum, it's overbought. Be careful buying charts like this. Do not chase. So that's what happened. Now you zoom the lens out about a year later and it did a round trip, $50 to 150 back in the 50s. It's $59 right now. Air pockets almost always burst. Look at the orange text. We just went through that. That was before it hit $150. Patience. If you had some patience, less than a year later, you can buy it for less than half the price of when I told you to not chase it. So it's pretty amazing stuff. This is why we trim parabolic rips. It's why we don't chase FOMO, right? We don't buy air pockets. Because, I mean, this is a massive air pocket. Here's your trend lines down here in blue. So you were buying this. Now this air pocket was up here. Here's your blue trend line. Well, now the stock's down here. If I'm going to buy the stock, this is where I want to buy it, knowing it can go lower, and it probably has a floor closer to 50, maybe 45 or something. But it's probably going to figure itself out somewhere in here. This is where I'd want to buy it if I like the company. Now, with all of that said, understand that Roblox is very much speculative and high risk, high reward, because it doesn't have any PE ratio. It doesn't have any profitability. So you are looking at no PE ratio here. And price to sales is about a 5. I'm not going to say it's crazy expensive, but it's not cheap either for what you get. You're talking about, decent growth here at 32%. That's the 30% I was confusing with the other one. Profitability, though, the margins aren't great for what you're doing, right? If it's a software related company, I want a hell of a lot more than 23%. And I'm still burning $350,000 net income per employee TTM. That's 12 months trailing. So it's very much a speculative type name. It's only up 10% in the past year. It's now down 18% in the past 5 years. If you look at a max chart, this went public 2021 in the pandemic for $69, and it's $60 now. So it's been a dog. It's one of those companies that's exciting. Of course, it matters when you buy too. You could have bought it at 37 and sold it at 150 and think this is the best thing ever. Now, we did buy some of this somewhere down in here in 2022, and we trimmed. And we didn't perfectly get 150. We might have trimmed at 125 or something. We did buy here. We trimmed here, and we own house shares. This is exactly why you go to house shares. It takes a lot of the stress out of it. Takes a lot of the emotion out of it. Makes life a little bit simpler, right? So yeah, here we go. There's Roblox. Next is IGV. This is the software ETF. And this is laugh my ass off. Wow. Nasty chart, 117 to 76. Trying to be like 57-year-old Will Smith and bounce back. So went to 76. It's bouncing back to 87. I don't know if you've ever seen this before. There's a video of him freestyle rapping. And no offense to Will Smith, he's He's had a great career. He's legendary, Fresh Prince of Bel Air. Everybody listened to Will Smith back in the day in the 90s and stuff. But it is funny seeing these guys in their, late 50s and 60s. Good for them. Hats off, right? But still getting after it and talking about how he's trying to bounce back. It's like kind of late to bounce back at 57. But anyway, because I do give him credit for trying because he's a hell of a lot better rapper than I am, right? Retested April 2025 lows here. So, I mean, this literally went down and look at this. This is why charts are so powerful. Because if you looked at this and said, hey, every time it gets down to like $75, buyers come in. Well, what do you think is going to happen? Algorithms kick in right in the same level. Look at that. Like clockwork, baby. Boom, buy, rip, buy, rip, buy, rip. And it's probably going to go higher. So where's it going to go now? It could break back down, retest, could always go lower. You've seen that before. But more than likely you got something closer to $100, so another $13 to get resistance, consolidation, maybe 50% retracement. With time, could it get back 100 plus? Probably. All-time high, I think, is 117 on this, right? So it was a little ahead of itself too, and came back and just went to that same level as April 2025, same level as August 2024. Every time we've had a software tech sell-off, it comes to that same $75, $76 price level. So charts can be very helpful for that because it gives you an idea where it might go. And we're looking at charts. I don't think I mentioned this in the beginning, but 99% fundamentals, 1% technicals, but we're using technical analysis to try to get better entry and exit points as long-term investors. And we're generally investing 3 or more years, right? So VGT is the next one. This is a great ETF. Actually, he wants VST. My apologies, but this is a great ETF you can check out. VGT. He wants to look at Vistra Corp VST. My preference has been DCA under 250 on this. Of course, it was recently 138, and now it's 164, 160. It looks like now. The fib range on this is 123 to 203. So market is open. You've got pretty much flat, a little bit of green. The VIX is still elevated at 24, but down quite a bit from that 35 high that we saw. VST though, yeah, I mean, it's not going to be a cheap stock where it's at. It's kind of a 50-50 ball here. Looking at risk reward, just looking at the fibs, right? Just looking at the fibs, you're kind of at a 50-50 ball, pretty much dead center. So you have to decide if it's part of your blueprint and then decide how to buy. We'll talk again later about the different types of DCA. I think that'll be really helpful. So this next one, he changed it to SNDK, but I already had he originally asked for SMHX, and I already had this one done, and I do want to cover this. Now, this came public in August of 2024, so we're right at the 18, 19 months, so it does qualify for this. Parabolic DCA, or periodic DCA, excuse me, this is where we're going to talk about this. And this is why I wanted to keep it, because it was so important, so I didn't want to switch it to the other one. Okay, so this is where you need to focus up and listen if you've been kind of dozing off a little bit. Slap yourself, grab some caffeine, whatever, right? This is SMHX. So SMH is a semiconductor ETF, the Van Eck. This is the fabless one that's only maybe 2 or 3 years old. I think it came out in 2024. SMHX. So this is the fabless. It came out August 30th, 2024. So all time it's up 51%, but it hasn't been out that long. This is going to include, right, SMHX holdings. This is going to have all fabless companies. So it's going to have the NVIDIAs, the Broadcoms, the AMDs, the ARMs. But if you dig a little bit deeper into it, it also has stocks like, can you see this? Yeah. So Rambus, Kurt Rambus, Astera Labs is about 3.59%. Lattice Semiconductor. There's a lot of names on here that the community likes. Most of these are stocks that we've talked about we liked. There might be a couple exceptions, but even like Cadence Design recently bought this in the community portfolio. That's 4.35%. It's a great way to get exposure. It is heavy on, NVIDIA's 21%, Broadcom 13%. So it is, damn near half of the portfolio is these two stocks. But for the right portfolio, the right blueprint, this could be a really good one to add and even mix in with SMH and things like VU and QQQM and whatever else you're into. SHG, there's a bunch of them, right? Spear Alpha, SPRX. You're looking for more of a thematic type play. But let's talk about periodic dollar cost averaging versus fired up wealth, technical analysis, lot allocation strategy, which we teach in the masterclass. So it's the acronym is FUWTALAS. Can anyone tell me who can tell me the difference between the two? Go ahead and type. You can tell me in the Elite Stream chat and Discord as we go through this live. What's the difference between the two? And even if you get that right, more importantly, can you tell me when and how you use each? I had a call with a VIP member last Friday, and she had listened to watched most of the master classes, and she was actually not 100% sure on this. She's building on her blueprint, and I could tell as she asked questions that she didn't fully grasp the DCA approaches. And I think a lot of newer members come in our community and they get confused too, because they see people buying stocks in the investing trade floor and they think, oh, well, this is whatever they think. I think that most people think that we only use the fired up wealth technical analysis lot allocation strategy. The thing you have to understand is that a lot of the people in the community have been doing this for a long time. They already have their portfolio baked out. They already have their blueprint baked out. So they're buying what we call fringe plays. So I'll come back to that in a second. So the difference, and I see Dave and a few people maybe writing the answers, and I appreciate that. This is a good learning opportunity for the community. Periodic DCA means you're investing periodically. So a amount of time. It can be every day. Like in the dividend portfolio, every trading day, I'm trying to buy $1,000 of SCHD for the entire year. So 250 trading days in a year. I want to buy $250,000 of SCHD in my dividend portfolio. It could be weekly. It could be bi-weekly. So every paycheck. It could be monthly if you get paid monthly, or it could just however you want to do it. It's a period of time, and you're buying really at any price. Like it could be the third Friday of every month. I'm buying $200 of VU. That's a periodic DCA. Now you would use that for cores like ETFs, but also core individual stocks. So say you wanted 5% of your portfolio to be Amazon. If you're starting a new portfolio and you're a new investor, you're using periodic dollar cost averaging really to build up your blueprint. So you're kind of building up a critical mass of the holdings, especially those core holdings. When we start talking about fringe players, those are opportunities usually after you have your portfolio baked out. So if I look at the investing club portfolio, the fired up wealth community portfolio, I wasn't buying really fringe plays for the first couple of years. I might have had some spec stocks, but they were part of a blueprint. So let's say you have your portfolio established now and you've baked out your blueprint and your percentages are pretty much in line. And you're going to be looking at that blueprint and doing an audit every year and seeing if it's still intact, maybe make some tweaks. You have to be careful of just completely ripping and replacing your strategy, but you'll make some tweaks, right? Twice a year, once a year, not like all the time, not staring at your portfolio every day, right? But now you've built out this critical mass. You've been investing for 2-3 years. And what I do is I have a list of fringe players. Now that's a list generally of 20 to 30 stocks on a watch list. And I will buy those stocks if they get to the right price. In other words, I like this stock. I don't have to own it. It's not a core. I'm going to buy it as a 1 or 2% position is what I'm calling a fringe player. This is something I have not gone into detail on the masterclass, and I will be adding more masterclass content this year in 26 after we get through the conference videos. And I'm going to include stuff like this and make sure I go in detail so that you understand what we're accomplishing here. So most of the buys you see in the investing trade floor, most of it is going to be established portfolios where they're buying these fringe plays, where it's like, hey, I don't have to have a Labs. Like maybe you do, maybe you don't, but let's just hypothetical. Labs to me is a spec player, but I do have a little bit more conviction. So I'm willing to go 2%, but it's kind of a fringe deal. If it doesn't get to $100 a share, I might not really buy it. I don't care if I don't own it. And it doesn't have to be a Labs. It can be whatever the stock is you're interested in. And sometimes those can get in trouble too, because you for GitLab would have been a fringe player. Didn't have to own it, got to a price I thought was attractive. Well, the price went even lower. It got even more attractive, but I didn't add because it was a fringe player. But like Expedia, if you remember not long ago, was it a year, 2 years ago, bought Expedia, rolled it up, made some profits, sold it. Names like Airbnb and some of these where If I create a blueprint, it might not be like a secular trend that's a core position, but it's something I wouldn't mind, owning or adding. And that's what's called a fringe player. And the fringe players are what we're going to use fired up wealth technical analysis lot allocation strategy for. Now you can use the technicals regardless, because what you can do too is on a periodic buy, you can say, well, hey, this is, SCHD is a little elevated, so I'm going to keep doing my periodic buy. But let's say it was the opposite story and SCHD was down, and you're looking at it, and it's like at the S3, and you're like, hey, I'm going to actually go $2,000 a month or whatever it is, right? So you can still use the technical analysis for any type of dollar cost averaging. But I think most people assume that everything that's being bought in the community is this technical analysis allocation strategy. And that's normally going to be for non-core holdings. If it's a core holding and you haven't built up a critical mass and it's a new portfolio, you're using periodic dollar cost averaging and you're just buying it a little bit at a time. And you're not super hyper focused on the price. Because if you're just starting and you're going to build a $2,000 portfolio, yes, price matters. But if you want to own, CrowdStrike is 3% of your portfolio because in your blueprint, you put 5% cybersecurity and you think, 3% of it should be CrowdStrike, and you don't have any of it, you want to buy at least some to get a critical mass. You don't want to just sit and wait. Like, hey, I want this to be a core stock, but I'm not going to buy it unless it comes down to $200. Well, then it's never going to come to $200 and you're not actually filling out your blueprint. So the fringe player is the one where you say, unless it comes to this price, I'm never buying it. And they're completely different things. And I hope I'm not confusing anybody. And if I am, leave a question in the comments, or if you're watching live, drop a question in the live stream chat, and I'm happy to address it. I think that for the veterans, it makes sense. For the newer people, it might be an aha moment, because for this VIP member, it was very much a aha. I thought we bought all of them off of this technical analysis lot allocation strategy. And I was like, man, I really want to buy some of these that are down a little bit, but they're not, down below the S3 and so on. So periodic dollar, excuse me. Dave replied here in the elite stream chat. Periodic DCA is auto set. Buy on a set schedule. Take all motion out of it. Set a day, a week, a month, and just buy on schedule no matter what. Well said. To deploy a lump sum or fill out a must-own position. So what he's saying here is if you have a lump sum, like in the dividend portfolio, I have a lump sum and I don't want to just go all in on Monday. I'm going to DCA slowly every day to deploy that lump sum. Or if it's a position you must fill out, like a core position, something that's 5% of your portfolio, something that's really important for the core of what your blueprint is. That's periodic DCA, and you did a great job explaining it. And then let me just show you. And then he says here, fired up wealth technical analysis lot allocation strategy is buying based on technical analysis when stocks you like are on sale to buy positions you want to add in your blueprint. And this is true. But what I'll add to this is that most of the buys you see are going to be fringe buys. In other words, they're not core must-haves. If they're core must-haves, you're going to use the periodic DCA to build up a critical mass, and you might add to your position by using this. So like say you want 5% and you periodically dollar cost average and you're comfortable and you get it to 3%. So you want 5% as your goal. You periodic DCA. So we're going to say P DCA, and you get to 3%. What you can do, this is more of an advanced approach, right? And you don't have to make it complicated. You can do it much simpler. But you get to 3% and say, I'm going to kind of just pump the brakes and save some room. And that way, if there's a big drop down, I'm going to be ready and I'll buy it, because I think that we are going to have it. And you don't want to time the market. So this is again a compromise, because this, you just bought it at a set time, this 3%. But you're leaving 2% room that you might use that 2% room for this technical analysis lot allocation strategy. Or you could just say, hey, because the thing is, if you're building on a portfolio, new money's coming in. So if I have a $5 million portfolio, that's a lot of cash to move the needle to get 1%. But if I just started a portfolio and it's $2,000 and I'm putting $500 a month in, you're gonna drastically impact that number every single time you put money in from your paycheck. So as a new investor, don't stress so much. It's most important to get invested and start the ball rolling, get that process going, get that blueprint baked out, use the periodic DCA to get started. And then as you get more advanced, you learn more, start implementing this fired up wealth technical analysis lot allocation strategy into it. And there are different strategies and approaches to use it where you can combine the two methods. I hope that helps some. I hope it's not confusing. So that is SMHX. That is one that you could use as a potential ETF. Another ETF here, WCBR. WCBR is going to be the Wisdom Tree Cybersecurity ETF. And it looks a lot like the IGV we just looked at. Fib range 20 to 29 here. So the two red lines. It's one of those things where, it certainly could go higher, it could go lower, whatever. But just looking at this to kind of give you a visual, this is kind of where you're at. It would have been much better buy at 22, 23. Is it a buy at 26? Sure. Upside in the shorter term, 28, 29. Longer term, maybe back in the 30s. You see a double top here at 32, exactly 32.71. This is one of the rarest things you'll ever see. A double top to the penny, more than likely an algorithmic type of a trade there. Great DC explanation. Thank you. And great job, Dave, as well, because I think we both explained it a little bit differently and it helps connect dots for people. So I appreciate that. Okay, so Unity is next. This is going to be in the same realm as like a Roblox. Roblox is probably even a little bit better quality than Unity, honestly. You look at something like Unity, it's been not a very good stock. Both of those were exciting, kind of those exciting type IPOs. You're like, man, this is huge. It's going to be big. Now, I will say Unity is running a 74% profitability, gross profit margin. And when we looked at Roblox, it's only 23%. So there is that, and it is also burning cash, $91,000 net income per employee. Not really that great of growth, 9%, especially considering you don't have this profitability for the P ratio and you're trading about the same. I think Roblox was about a 5. This is about a 4.28 price to sales. So if you're buying this, the financials aren't great. So the qualitative analysis, the story also isn't very good. It's not really cheap. Technically, it's kind of following this trend. It can go lower. S3 is all the way down here at 778. But my question is, this has been a dumpster fire. Do I even want to own this? Are there better stocks I can pursue? Because the management's dropped the ball. There's not a lot yelling at me like, hey, I should go out and buy Unity software. But maybe that's different for you, and that's totally fine. We're not here to create sheep and herd mentality. But this was a $15 to 46 to 16. Traders are wild, right? It goes from 13 to $50 to $16. Could it be a trade? Could it be an opportunity? Could it bounce? I mean, all those things could be true. Does it fit in your blueprint as a long-term investor? Maybe, maybe not. And if it is, it's probably spec, right? 1%, 10x or 0 type thing. The problem is you're not going to get a 10x on this because it has no growth. So if I'm going to do a 10x or 0 spec, I want it to be, something like Astera Labs maybe. And Astera Labs is a hyper growth, so you can go a little higher than 1%, maybe 2%, because you call it, we got that spectrum from spec to hyper growth, what have you. But yeah, this Unity is one. Put some extra energy into the due diligence on that because it's not a great story overall. Kratos here, CTOS, fib range 69 to 115. Same kind of deal. It's like it's not super attractive here, but there is at least more upside than downside. Of course, 134 is the high. You're kind of buying an air pocket, especially up here. You can see 134, the trend line's way down here. It probably kind of holds up in here. 200-day moving average is 75. But generally speaking, just look at the chart. It's not something I'm super excited about just from a technical level. But with that said, it could certainly go higher, especially with the Middle East tensions and all that. Intel. I'll just be honest with you, Quantum Queen. You're chasing if you buy it here because you had a year to buy this thing. It was literally just sitting here at $18, $19, $17. And if you look at this, it goes from July 2024 to August 2025. You had a full 12, 13 months to buy here. And yes, it was 54 and it pulled back a little bit to 47, but you definitely are chasing pretty significantly at $47. And I do like the new CEO. I like the direction they're going. I've said a lot about this stock over the years. It's something I owned for a long time. I made a lot of money on this stock over the years. Again, why I truly believe in the trimming approach and playing to win, because with Intel, it's one of those things that could have gone to zero and I still made quite a bit of money on the stock. Growth, it has no growth. 2% growth. Profitability is 36. Well, meanwhile, Nvidia is rocking a 75%, and Astera Labs in the 70%. It just doesn't have the pricing power. And then valuation, it doesn't even have a P ratio because it's going through some stuff, and I think it's finally kind of in the profitability metrics now, but a lot of these are, TTM, so they're lagging, 12 months trailing. But just overall, I mean, they're going in the right direction, but it's kind of priced in, is what I'm telling you. I remember saying, like, hey, if you're going to buy this stock, the time to buy it is under 20. If it says even here, Intel, DC under 20 if you have conviction. It's not something I have a ton of conviction in necessarily, but you could have doubled your money, from 20 to 40, or even more than doubled your money up here at 54. But do I want to pay after it's doubled when the story isn't that compelling? Personally, I don't, but you have to decide again. Does it fit your blueprint? What's it best of breed at? Because it's not. It's not best of breed data center. It's not really best of breed in CPU. It does a lot of things not best of breed. It does lots of things and some things well, but it's not crushing it like NVIDIA's best of breed GPUs data centers, AMD's best of breed CPUs data centers. And they're even ahead of the game when you think of GPUs, but that's not even why I buy them. I buy them for the CPUs. And you can go on and on with these best of breed and why it's best of breed. I struggle to find something that this company's best of breed at, and therefore it doesn't fit in my blueprint. ACMR. This was a great fired up wealth winner. We made a lot of money on it, nice profits. I sold out of it in the main, not as high as I could have. Of course, I sold, sell at 40s and 50s. It goes to 70 type of thing. But you can see how fast these snap back. And it was ahead of itself here, and now it's pulled back. If you look at the valuation, it certainly still has lots of upside because there's lots of potential. There is risk there with China. We always said to treat this kind of speculative because of that heavy concentration in China. I mean, it's a California-based company, but all of their business, 90%, I think, plus, the last time I looked at it closely, was China revenue. So, growth-wise, 15 and 20%, profitability rise, 44% for what they do, a lot of cleaning equipment, things like that. So semiconductor equipment. Valuation, 23.4 gap P ratio, not terrible. Not paying a dividend, sitting at $3.16 billion market cap. It is up 78% in the past year. It's up 50% in the past 5 years. So it's been a nice winner over the last year or so. You look at this and say 23.47 is not too bad. When we bought it, though, I think it was like a 10. So it's definitely increased in its valuation quite a bit. If you look at the historical PE ratio, it's still trading at quite the premium to its historic trailing in that $48 price. Next is AbbVie. I've actually owned this stock for a while. I've done well with it. I think of it more as an income type stock. Right now, AbbVie's paying you 3% dividend. It was higher, but the stock has kind of gone up over the years and the dividend hasn't really caught up with it. But over the past 5 years, it's up 108%. So a lot of people would be surprised by this. If I look at the QQQ and think, oh, the QQQ has to beat AbbVie. The QQQ is up 93%, which is really good. And the AbbVie in that same period is up 108%, plus it pays you a 3% dividend. So this thing's crushed it over the last 5 years. Do I want to go buy it at 226? I mean, I don't really love it there. I mean, this is showing a 95.78 P ratio, which is going to be, let me just double check this. Yeah, so this is more accurate, 25. So this is a PE gap TTM. This is your forward PE gap, 25. It's around a 25 forward. That's what I want to look at. Growth, it's not great at 9%, but better than a lot of the stocks we've looked at that are supposed to be these exciting growth opportunities. And profitability, very strong, 71%, better than a lot of the companies we looked at. Again, A+ profitability. It does pay that dividend, and it's had 12 years of dividend growth. This number isn't that high, which is part of the reason, too, that this used to be a higher dividend. The price has gone up, and they haven't really grown the dividend with the stock price. 3% or 1% short interest. $401 billion market cap. Where it's at right now, kind of a 50-50 ball. Previous S3, actually, this is the current S3, 192 down here. You've got the R3, 254, and you're sitting kind of in the middle, 50-50 ball. Doesn't fit your blueprint. Why? This is probably more of a dividend stock. It wouldn't be in a growth portfolio, right? So understand, too, that when you see me buying stuff in the dividend portfolio, this is another thing I think people confuse, especially newer members. So we have 3 portfolios. One is the main. The other one is the community portfolio. The other is the dividend. So the community portfolio is me going back in time 20 years ago and trying to rebuild the main. The main is something where I've been investing a long time. That portfolio is about 10 years old or so, maybe a little older. Build it from 0 to where it's at, 3 million. It was actually 4 million, and we transferred $1 million of profits over the dividend portfolio. So the community portfolio, most people are following that. They've got 10 years, 15 years before their financial freedom, their number, their goal. The main is once you've done it. And then the dividend portfolio is when you start to transfer from that main to the passive income. So Fired Up Wealth, financial independence, retire early with dividends. You're using growth to outperform. You're using the 8 out of 10 Fired Up Wealth methodology, the blueprint methodology we teach in the masterclass, the community portfolio. You're using that to grow. You're outperforming. You grow it into the main. The main is after you've accomplished that, you're de-risking a little bit, you're selling some profits, you're trimming profits, you're converting that into dividend portfolio. So you've got accumulation phase, preservation phase. Accumulation phase is the community portfolio. The main is somewhere in the middle, closer to the end at this point, because we've already started to de-risk it from 8 to 6. So we got 8 out of 10 risk in the community portfolio, 6 out of 10 risk in the main. Dividend portfolio is 3 out of 10 risks. That's taking profits that you made from building that community portfolio, 8 out of 10 risks, from that, which converts into the main, taking profits from those growth stocks, the outperformance, trimming that outperformance and putting it into dividend stocks. So we're going from accumulation to preservation, and now we're building passive income. So on every $1 million, I've got, 3.5%, 4% dividend yield. So I'm getting like $40,000 every year. So you get to $2.5 million portfolio, boom, you got $100,000 of passive income. Now, every person is going to be different. There's going to be ACA and your medical bills and how that works. And there's a million scenarios that go in, and it's going to be very unique. So you have to understand, retirement accounts can be really important and part of the factor. Taxable brokerages are a great way to bridge to retirement, but you need to have an overall plan. And we can't custom build every single financial plan to every member unless you're at VIP. That's the point of VIP, by the way. But if you're not in VIP, we can help you with these decisions, but you still have to understand, like, what's your goal? If your goal is to work to 65, you might not need as much in a taxable, or maybe not even a taxable. You could do it in your retirement account. If you're trying to retire at 30, you're going to need a big taxable brokerage to bridge that gap to retirement and so on, right? But you also have to be thinking you're young right now and you don't know exactly what the tax ramifications are going to be. So people like me, people like Dave, others, we're going through this process now from that conversion into that passive income. And it's going to be different for every person. But now we can share that journey so you learn and you can make adjustments beforehand. Because everything I'm teaching in the masterclass is all the mistakes I made over 20 years investing. And now I'm doing it again to show you, well, when you do convert it and you try to, have financial freedom at 40 or 45 or 50 or whatever it is, here's some of the things to look for. Like, you might want to have more ETFs because everybody says they can buy them later, but nobody does. And then later they say, I wish I would have bought more ETFs. Every single person I talk to on mentoring calls, my ETFs, I want 20%, but I only have like 2%. I can buy those later. I'm focused on individual stocks. I talked to somebody that's been doing it a while. They'll say, when I was in my 30s, I thought I'd buy those later, never did. And the grass is always greener, right? Because you can certainly outperform if you buy the right stocks. But the nice thing about ETFs and why you want to have some is you might not necessarily have to sell those and pay taxes. Where in the individual stocks, when you're de-risking, you're going to end up selling a lot and paying taxes on a taxable brokerage. An ETF, if you own the S&P 500, you don't necessarily have to sell it. It can be part of any type of portfolio. But if I own Rocket Lab, I might not want Rocket Lab as an end game, type thing. It might be too high a risk for my blood when I'm at retirement end goal plan, right? So very case by case stuff to think about. Coherent here. This is Fired Up Wealth winner. Chasing here, of course, if you're buying now, um, has come down a little bit since last night, but here's your risk reward. Not good at all. This is a buy somewhere, in here, and it's done well. We've trimmed out. This has been a great winner. I don't know if I'd chase here. I'd be really careful. Could it go higher? Sure. The answer is always it's going to go higher until it doesn't. The R3 is up here at 338. But it certainly is not cheap at this point, right? This is where you want to get ahead of these and buy them before the masses. We've done a good job of that over the years, and you're not going to be right every time. But we've been finding a lot of these winners over the last 6 years, and that's really helped the portfolio performances and things like that. But you look at profitability. I mean, it's decent, but it's not anything like an Nvidia. Growth 20% strong. Valuation not cheap, guys. A 64 and Nvidia is trading at 22. I'd argue Nvidia is a better buy right now than Coherent. Do I like it? Sure, I like it. But, and there's future to this. But just understand, like, when you're buying something like this and it's kind of late to the party, you're paying a premium. It doesn't mean it can't go higher, but those exponential gains from, $60 to $260, those are gone. It's not going to give you another 300% or whatever the hell that return is. You're not going to give you that again probably in the next 3 years. And you got this in like a year. I mean, literally April 2025 to now, at less than a year, you went from $60 to 260. And you're talking about 300-400% gains. That's pretty incredible. So yeah, that's Coherent. It's been a good winner. Just be careful. Obviously the lower the better when you're buying stuff like that. PTSG, it's actually PSTG. I got confused with that. PSTG. There we go. And let me fix this one. For whatever reason, I like to say PTSG, like PTSD, I guess. Probably have some of that of my own. Same as last. The orange is always the previous chart day. Yellow is today's chart day. S3 is 51.73. Buyers are coming in around $60 at 62. Could always go lower. And it was $34 in April. So understand that. This is actually Everpure. So they changed their name or something. I'm confused. ESTG. I've never owned this. I think I was thinking of something else. Oh yeah, Pure Storage. I was like, isn't this Pure Storage? The ticker is literally Pure Storage. Pure Storage now branded as Everpure. Is it just me, or was Pure Storage a better name than Everpure? Everpure? Sounds like Everclear. Like I'm going to go drink some grain alcohol. Some college flashbacks, bad memories. Anyway, yeah, I mean, it's below the trend. S3 is 51. It was $100. It doesn't fit your blueprint. I know you get tired of hearing that, but that's the main thing, right? Because if you have conviction and you think it's going to do well, the chart's not really that important. It's 1%. This is T-Row. This will probably hurt some feelings, but this is an income stock. The only reason that I would personally own this is because I would want a dividend. And I'll just show you why. So T-Row, you got profitability, 51%, fine, bringing in good money, 268, really, really healthy numbers there. Growth, it's not growing at all, 3%. So there's no growth here at all. In fact, when you get into a recession, it's going to get negative growth and the stock's going to get hammered. Valuation, it's cheap, but that's because if you look at the sector median, well, the sector median's a 10 and this is trading at a 9. And if you look at JPM and a couple of names, they pull that sector median way up. I'd say that most financial type institutions, banks, brokerage services, they trade in this range roughly, right? If I look at Bank of America, which I know they're different, but this is an 11. And then you look at something like JPM, and JPM is a 13. I'm actually surprised Bank of America is that high right now. I look at like a Citigroup, that's sitting at a 10. US Bank would be another one you could look at. It's more regional. They're mostly sitting around 10. So could you argue that T-Row maybe could be a little bit higher if it's sitting at 8.62? Maybe it is a decent price. It's a little bit under the sector median of 10.27, right? Dividends, though, this is paying you a 5.83% dividend, 52% payout. Anything over 50% payout, basically, it's going to get into income stock territory. And there are some exceptions. It does have nice 39-year growth. Anything over 5% dividend yield generally is an income stock. If I look at 1 year performance, it's down 7%. In the last 5 years, it's down 50%. So this is like a bond where you hold it and it's paying you, but you're actually losing money. And this is the problem with, income stocks in general. Now, this could be a good buy, and that could, it doesn't mean just because it's down 50%, it's not a good buy. But if you held this the last 10 years, it only gave you a 21% return. So why do you hold it? You hold it for the dividend. The dividend's paying you 5.83%. So you want to buy the stock and you just hope that it stays around the same price. You're not expecting this to go to $180. If you can sell this in 10 years and it's $100 a share, you're thrilled, because the main reason you bought it is it's like a bond paying you 5.83% dividend. This is what you would own in the end game passive income dividend portfolio. You would not buy it in the growth stages at all. You wouldn't buy it in the community portfolio. You wouldn't buy it in the main portfolio. You would buy this only in the dividend portfolio as a dividend income stock. And that's all it is. So the chart's not that important really, other than, well, it can go lower, it can go higher. But yeah, $82 in this range here is what, 107. That's a pretty big range actually. But your downside, you're probably $75. This is April 2025 lows. It's $10 more. Of course, the lower it goes, the higher the yield, and you're happy in that sense. This is not something most of you should be looking at. T. Rowe Price. Just want you to understand that. You can't buy this stock and say, oh, it's a DGIF stock, I'm going to put it in my GGF bucket. That's not how it works. No, this is an income stock. This is for like the end game retirees, not for 20 and 30-year-olds. ZS, Big Nate. This is the last one. Did I miss any? Hopefully this has been good. A little over an hour. I didn't get to talk to you Monday very long because we got contractors out here. It's been wild. I got this new HVAC system. It's amazing. It's so quiet. It's so energy efficient. And I wish I would have done it sooner. Woulda, coulda, shoulda. Zscaler, same for years. I've been saying the same thing for this for as long as I can remember. $175 or less DCA. So if it's 156, do I think it's a decent buy? Sure, because I like it under 175. The lower, the better. Now, the S3 is all the way down here to 100. I don't think it'll go to 100, but it could, because in 2022, these names like this literally went down. CrowdStrike was $98, and this was under $100, and they were all beaten down. So can it go to $100? Yes, it can. Can it go to 336 again? Yes. Well, so let's just look at that. And this is not a reason to buy. I want you to understand that. It's a visual to give you an idea of risk reward. So if that's like, we think it can go to all-time highs, we think it can go to $100, we know it can, right? And we say, here's the price down here. Your downside's still pretty significant, because 156 to $100 is a big deal. You can lose 50%. On the upside, 150 to 336, now you're doubling your money. So 200% gain, 50% loss. I would like that even a little bit higher on something like this. And that's, but at the same time, 175 or less DCA. So I think what I'm going at is it's priced right now here, 175. Yeah. So I still like 175 or less, but I want you to understand it can go to $100 a share. Does that make sense? I'm going to get rid of that. The big thing with Zscaler, does it fit in your blueprint? And then why? You say, yeah, it fits in my blueprint or my cybersecurity. Okay, as what? Well, it's best to breed at what? And if you're building a cybersecurity bucket, it's probably going to be something like CrowdStrike. Zscaler is one I like, but more of like a 1% or 2% holding. And I want to remind you guys that if you haven't worked in software, and this is not to try to make people upset, but if software is not something you've been around a lot, and you've worked in software, you've understand stock-based compensation, how venture capital has worked over the years, I tell most people just to avoid SaaS names like Zscaler. And if you do buy them, treat them as spec. And that has served you well if you've listened to that, because they've been very all over the place. You have to be very, very disciplined to not overpay on something like this, because, I say 175 or less DCA. Well, yeah, you bought it at 175 and you DCA. If you bought some at 175 and some at 40, 150, you're still doing pretty good. You might be par, might be down a little bit, up a little bit. But if you're buying at 336, this is where you get butchered. And this is where you have to be really disciplined, not buying these air pockets, right? So if you are buying those, I wouldn't treat them as like a core position at all. I do think there's risk to these kind of names. They're still expensive. They trade on, EV/NTM revenues, not necessarily P ratio. Most of them aren't going to be gap profitable, right? So you're going to see non-gap EPS, things like that. Understand that. And that is a risk in this type of market, especially where quality matters, profitability matters. You shouldn't have a portfolio just all of Zscalers. I do like them, but if you look at my portfolio, I worked in software for 10 years and I own some of those, but Zscaler is like 1% of my portfolio. A lot of people are surprised thinking it's this huge core position or something. Even CrowdStrike isn't a huge position. I try to keep most of my software and cloud names, I think 10% or less generally in that portfolio. And I am hardware heavy, especially when you think of semiconductors, but I think that's where you want to be when you think of AI build out right now. Those are the picks and shovels that really are going to keep going higher with time. So I hope some of this helps. We go through some of the real talk as we go along. One thing with investing that's really important, I think, is when people start out, there's a lot to learn. And I talk to people every single Friday for mentoring calls, for VIP calls, and I hear the same thing over and over, how, I want to learn this and the community is great. I don't have time to do this. I don't have time to do that. Somebody asked me, hey, how many stocks should I own? Well, it depends. How many can you manage? Well, I think I can manage like 50. Okay, well, explain to me your definition of managing those 50 stocks. What does that require? Oh, well, I read Discord and I look at if the earnings beat or not. And I just try to keep up on what they're doing. Okay, that's not a good answer. Are you telling me you're not listening to earnings calls? Well, sometimes I read through the transcript or I'll ask AI a question. I'm like, that's not the same. Now, I'm not expecting every single person to listen to every single earnings call, but if you want the truth, I listen to almost every single earnings call for every stock I own. There are some exceptions in some of the smaller spec stocks. I'm not listening to every earnings call, but if you think of a core position, NVIDIA, Microsoft, CrowdStrike, these kind of names, I've owned these for years and I've been on every single earnings call, 4 of them every single, year. And I've listened to every single call, and not only listen to the call, but then get the transcript and read the transcript. And now I'm using, after I've already listened to it, I'm using AI to say, here are the 10 bullet points or 20 bullet points of my notes. Take this and make it better. And I might use that before I post it in Discord or something, but I'm not just relying on AI and just copy pasting it. So he's like, well, there's no way anybody here is going to have that much time. We're all working full time. And I said, well, I worked full time in software and I was working 40, 50, 60 hours a week. And I would still put in 20 and 30 hours and sometimes more into my investments. And I know that's crazy, which is why I wear the alien hat. And I'm not saying everybody has to do that, but if you have 50 stocks and you're not doing any work on them at all, you can't borrow conviction from the community or from me. Just because I listen to the earnings report and I believe something, you can't just say, oh, I just trust you. I'm not your financial advisor and no one in here is, right? So my suggestion to those people is, if you can't manage 50 stocks and you can't keep a better handle and all you're doing is relying on Discord, you might want to have less than 50 stocks. You might need something like 20 and, have some more ETFs as that core and then build around with companies you really understand. Buy 20 stocks of businesses that you really understand, that you really have conviction in, that you're excited to learn more about. So if you listen to an earnings call, you're not bored to death. I know that not every single person in here, including our veterans, I know not all you guys are listening to every earnings report. I'm not saying that you have to be Eric and just be crazy, but I do expect you to listen to some of them. And I expect you to do a lot more than just read X comments or come into Discord and say, that's my due diligence for the day. The Discord community is there to help expedite a lot of that and to give you the information in real time and granular. And it will save you tons of time, but it doesn't replace all of the work. That conviction can't just be borrowed because a couple of members in the community like, hey, I like Derek and he says he likes his space stock. I'm just going to go buy it because Derek does. And you can do that. I can't recommend that you do that. The problem, if you do that and the stock falls, it's human nature for you to blame everybody but yourself. And so you're going to say, oh, that stupid Eric guy, that Derek guy told me to buy this. That's not my fault. No, you need to own it. You need to go out and own it and say, yeah, that person liked it, but I also did my own homework and I like it too. And if that stock goes lower, I'm buying more. I'm not going to panic sell. The thing is, if you don't have that conviction and you're borrowing conviction from me or someone else from the community, you're going to panic sell. So when you get the next 2022 bear market that we had, you're going to panic sell. You're going to take your ball and go home, and you're going to blame everybody but yourself. And then in a decade, you're going to regret it. And you're going to think about what could have been. I don't want you to be that person. So yes, it does take a little bit of effort to be an investor, but it doesn't have to be a 50-hour week job. You don't have to be insane like Eric. The main message here, though, is maybe you shouldn't own 50 stocks if you're that busy. Maybe it needs to be something like 20 and it'd be more manageable, and you can stay on top of those companies a lot better and understand those businesses. So some food for thought on a Wednesday. Thanks for listening, guys. Thanks for watching. Have a great rest of your week. We'll see you.